This week we're going to look at the investment numbers for Australia that came out yesterday. We saw that overall capex spending fell by 4.4% in the March quarter, with the declines fairly well spread across the major sectors. Mining down more than 4%. Manufacturing, which on this chart is the red line, was down quite heavily after a rise in the previous quarter, and also the service sectors were also in decline. So a very poor result for investment in Australia. If we look at each of the sectors one by one, first I want to turn attention to the mining sector investment series. You can see here the climb since 2005, when investment on a quarterly basis was going from about 2 billion to about 24 billion. It's since fallen away to 19 billion. Now, if we use the projections that are included in the CapEx survey for the mining sector, and I'll just explain what is happening here. Essentially, the ABS have a high realisation ratio and a low realisation ratio for the expectations for the expectation numbers. If, for example, it comes in at the high end of expectations in 2015-16, the quarterly mining capex number would end up being around about 13 billion per quarter, still a substantial decline. If it ends up being towards the lower end of the realisation ratios, you can see there the pink line has it down around about a little bit over 10 billion. So on an annual basis, mining capex could fall from an annual rate of about 77 billion in 2014-15 to, at best, perhaps 52 billion, and at worst 42 billion. So the decline of anywhere between 25 and 35 billion is a real possibility. That's a decline of 30 to 40% in mining sector capex. Now, when you think about that in terms of a proportion of GDP, which we'll just do now, and that's the that's overall capex. So for mining capex, that's a proportion of GDP. Now, if we include the projections as well, what that would suggest is these two numbers. So as a proportion of GDP, mining capex has fallen from a peak of about 6.5% using this data down to 5%. It could fall back to sort of 3 to or the low 3% over the next 12 to 15 months. So quite a significant decline. What about the other sectors? Turning first to manufacturing, which is a relatively small investment component, that has been falling away, as you can see here. If we use the actual projections from the ABS survey, both the high and low realisation ratio, you can see those coming in. It would take capex investment within the manufacturing sector back to levels not seen since the late 1980s and the early 90s recession. So quite a dire situation in terms of manufacturing sector capex. Perhaps the great white hope for Australia has been that we would see a pickup in investment in the other sectors, which includes, of course, service sector. So if we just now have a look at those, that's the capex in other, and if we include the most recent forecasts, this is what we get. So basically that would have it holding at these fairly elevated levels. So there has been a strong lift in non-mining, non-manufacturing investment over the last 10 or so years, but although it would appear to have slowed down in recent times. So putting all this together, and in the context of what it means for overall GDP, GDP in the Australian economy is around about 1,200 billion, of which 200 billion is in non-dwelling investment. Dwelling investment accounts for about 80 billion a year. So let's think of 200 billion in investment. We're talking about a potential 25 to 35 billion drop in mining sector related investment over the next 12 to 15 months, which would amount to somewhere between 2 or over 2% of GDP. So it's quite a significant headwind that the domestic economy is facing, and one that is going to be very difficult to overcome, even though we might be positive on the dwelling side. As I mentioned, dwelling investment is about 80 billion, but there's no way it's going to be able to make up for the lost ground that's occurring in the mining sector, but also to some extent the lack of growth that we're seeing in the other sectors, including the service sector. Thank you.